Hey everybody, Ryan Reel, Senior Residential Specialist with the Wanabo Real Estate Group. All right, we're coming to you with the full report today. We have the full housing and financial report. It is April 20th. We're going to get into where we currently are with the market. We're going to get into the recession. Are we in one? What's going on? What are the projections? Second big topic, what's going on with unemployment? Where are we? What are the projections and what does that mean? And then third, what's going on with the housing market? Where are we at and what are the predictions going forward? All right, let's get to it. All right, everybody, a few notes as we get started. First, created and recorded on the evening of Monday, April 20th. It is released on the morning of Tuesday, April 21st. It is important to timestamp and date these due to the rapid day-by-day nature of the market. Special thanks to Steve Harney over at Keeping Current Matters, him and his crew, outstanding. Tom Ferry, his coaching group, outstanding. They are a large source of the graphs, charts, and research that we're going to show here. All right, so the agenda, where are we currently at? Recession, are we in one? What's going on there? Number 3, unemployment, current and projected rates. 4, home values, historical comparison to the Great Depression and mainly the Great Recession. Number 5, the executive summary. So you can see the timestamps that have popped in. So if you want to fast forward to a part of this that makes more sense to you, this is obviously the full version. You can also head to the YouTube channel where they are broken out into shorter videos. All right, so let's get to it. Methodology, very simple. We're looking for long-term and reliable resources for market information and analysis, as well as the science behind their analysis. Those are just some of the organizations, institutions, companies that we look at when they put out information. So a disclaimer, first, nobody can give you perfect advice. If anybody tells you they can, run away from them and do it quickly. Everything that you're going to see here is based on what we see taking place in the market. This is also what the science has to say about it. So based on all of the above, the following is the best advice I can give you today. So how's the market? On the ground, it is still day by day. It's no longer hour by hour, definitely day by day, as more and more talk about easing the stay-at-home order comes about, as we start to reopen the economy in the next few weeks here in California. It's still day by day. About 75%, 3/4 of my buyers and sellers, they're telling me that they're on hold for now. No problem. They've been there for a while. 100% supporting that, continuing to communicate with them and keep them aware of what's going on in the market. Another 1/4 of my clients, they need to buy or sell now for various reasons, and that's what we're doing with different protocols in place for safety, smart marketing, virtual open houses, virtual showings, and more. All right, so what's going on with the recession? Are we in one? What is a recession? How do we know this? The easiest thing to do is going to be to look at the definition of a recession. A period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. We are not technically in a recession. The final data from Q1, January through March, has not been released. So we cannot formally say that even Q1 was a negative, right? We know that it was. There's nothing that's going to magically change about that. Q2, April, May, and June of this year, that has to also be negative in order for Q1 and Q2 to be successive negative quarters. We know Q2 is going to be negative. We know that. So are we technically in a recession? No. Are we functionally in a recession? Yes, we are. Absolutely. Right? So what are recessions? What do they look like? Right? So we have the answer of what they are. There's 3 main types, and here's what they look like. The first one is the V shape. Right? So that's characterized by that rapid drop, well-defined trough in the bottom, and a rapid return back. Right? That's what we're hearing a lot of people talk about, the V-shaped recovery. That's the one we want. Something that's starting to get into the conversation now is the U-shaped recession. This is still a very rapid drop down to the bottom, but the bottom or the trough is not well defined. There are ups and downs, peaks and valleys through that. They're characterized normally as being longer than V-shaped recessions, but when they do come to an end, they do come quickly. The last type is the L-shape. This is what we saw largely in 2008, 2009. We saw a rapid drop and then a flat line. That we obviously do not want. So what are the predictions for 2020 for GDP? All right, so we're looking at Morgan Stanley, Goldman Sachs, JP Morgan, Wells Fargo. right? 4 of the major financial institutions in the world. Q1, negative, minus Wells Fargo. They're optimistic, apparently. Q2, everybody agrees is going down. Q3, everybody except Wells Fargo agrees we're going to be massively positive, right? So we have 3.4%, negative 39%, 20%. That's just with Morgan Stanley. It's a point of reference for you of how deep that's going, right? Q4, everybody's positive. So this is very clearly predicting a V-shaped recovery. That is good news, and that's what we're really hoping for. Right? So JP Morgan came out and said the COVID-19 recession might only be 1 or 2 months old, but a few signs of the always hoped for V-shaped recovery are starting to emerge. That's good news. A Harvard Business Review says it's worth looking back at history to place the potential impact of COVID-19 empirically. In fact, V-shapes monopolize the empirical landscape of prior shocks, including epidemics such as SARS, the 1968 H3N2 Hong Kong flu, the 1958 H2N2 Asian flu, and the 1918 Spanish flu. Another highly respected consulting firm, John Burns, historical analysis showed us that pandemics are usually V-shaped, sharp recessions that recover quickly enough to provide little damage to home prices. And some very cutting-edge search engine analysis by our information management team showed the current slowdown is playing out similar thus far. So what does it mean? You have the 4 leading world leading financial institutions. Make it 5 with Merrill Lynch, Bank of America. You have Harvard. You got a whole bunch of highly respected institutions, all basically saying the same thing. A bird that's sitting on a tree is never afraid of the branch breaking because its trust is not on the branch, but on its wings. So what does that mean to the economy? What it means is this is an event-based recession. If the coronavirus had not come to the United States, we would not be in a recession. The underlying economy was very, very strong. The housing market was and still is very, very, very strong. The underlying nature of the economy is very different than what we saw in 2008. All right, so that's the original GDP prediction from JP Morgan, Morgan Stanley, Goldman Sachs. All right, so what does all this mean? It means nobody knows exactly what's going to happen. Between JP Morgan, Morgan Stanley, and Goldman Sachs, they manage over $1.7 trillion for the wealthiest people in the world. For them to come out with a prediction and to be wrong costs them billions of dollars. Yet all 3 agree. That's good news. Here's a better example. Everybody's seen this. Dr. Fauci can't tell us when the pandemic will end. Every day he's on TV. He's not hiding from the fact that he can't give perfect advice. He's giving the best advice he can. So based on what we see taking place, what we know today, and what the science says about past recessions and or pandemics, here's the best advice I can give you. We know that 96% of the country is staying at home right now. That means that new listings are going to be down. It means that sales are going to be down. We know unemployment has skyrocketed in the last 4+ weeks. But we also know that real estate is still happening. Homes are being bought and sold every day. So based on that, we expect to see a very sharp drop to the bottom in Q2 with the economy skyrocketing back in Q3, Q4, and into 2021. Q2 is April, May, and June. Buckle your seatbelts, ladies and gentlemen. Keep your hands and feet inside the cart at all times because it's going to be a very, very interesting ride down with an exhilarating ride back up. This is the best advice that I can give you right now. It's a great quote from Steve Harney. The reality is the economic reports released over the next few weeks will look horrifying because the pause button has been hit on the U.S. economy. Remember, home sales for the first 2 months of 2020 were the best they've been since 2007. Then the world stopped. Once things get back to normal, we will be fine. Don't let the upcoming headlines rattle you. We know sales are going to be down. We know in a month or 2 months, the reports on the TV are going to show this. Keep something in mind with housing. At best, the news is only 30 days behind. Normally, it's at least 60, 90 days behind. So what does it mean? What has to happen? From Goldman Sachs, if policymakers manage to thread the needle between continued virus control and the gradual reopening of the economy, the level of GDP should begin to move higher in the months ahead. If you have never tried threading a needle, I would highly recommend giving it a shot, because we're asking the federal government, the state government, and the local governments to thread a needle with balancing public health, public safety, and the economy. There has to be a balance between the two. If one of those two monopolizes the other, we're going to have a big problem in one way or the other. So let's take a look at unemployment. The graph that's coming in, this is a scary graph. You can see unemployment from the 70s bouncing around well under a million, and then boom, March 15 to 21, 3.34 million, then 6.65 the next week. So here's the numbers in their full glory. March 21st, 3.34 million unemployment claims were filed. 6.9 million, 6.6, 5.25. The next one from the week of the 18th isn't due out until later this week. So we don't know what's going to come next week, or from this past week. It's later this week that comes out. We do, though, want to ask this important question: who's lost their job? What industries make up these numbers? So if we take a closer look at this, we need to be very clear that the industries I'm going to explain to you here in a minute, is not reflective of the full 22 plus million people at this point. It is not reflective of it. It is only indicative of the first 700,000 people that filed for unemployment benefits. This may not be reflective of the other 21 plus million people that have filed. Please understand that. The next report that comes out is released on May 8th. But what are we looking at? What are we looking at in terms of industries and jobs? The first one is the food and drink services, 60%. Are those coming back when we come out of quarantine? Yes, they are. 100% coming back. Child daycare workers. Those of you with kids know it's coming back. And if they want more money, we're probably going to give it to them. But that's 3%. Healthcare, right? These are the office workers, the technicians, the hygienists. They haven't been working. These medical offices, there's a lot of hospitals that are feeling a tremendous amount of strain right now because they can't operate as normal, pun intended, I guess, to keep their business going. They're going to come back. Same with construction workers. So they're 73%, approximately 73% of the economy should come back very, very quickly once the pause button is pushed again and we go back to play. It'll be interesting to see how quickly that is in reality with whatever new social distancing and other guidelines come out. But they're coming back. What about the accommodation industry at 4%? Hotels, airplanes, cruise ships, retail stores, temporary help services. Those are coming back. We just don't know when. When are people going to feel comfortable getting on an airplane, going on a cruise, going to a hotel, going on vacation? We don't know. Not day one. Retail trade stores, those are going to come back. There's some very promising news coming out of China that a lot of the people are going back to stores very rapidly. It's coming out of communist China. Take it for what you want. Temporary help services, as all these others come back online, the temporary help services is going to also. We have another 10% of the economy that's not going to come back. These are the coal mining industries and other similar industries. They've been going away. They're not coming back. These are national numbers that came out on April 3rd, 18 days ago. The new report is due out on May 8th, and we're going to have a far better idea. So the key questions that we need to ask: when's the pandemic going to be over? When will the economy come back? And when will people go out again? Number one and number two are interrelated. That's the needle that has to be thread. Federal, state, and local governments have to not only be aware of public safety, public health, they also have to be aware of the economy. And that's the battle we're seeing on the news today. The pandemic will be over when the pandemic is over. Nobody can tell you that. The economy will come back. Can we tell you when? We can give you a range. Q3, Q4. Can't give you a date. But we know that the first step to that is pushing the play button. And that's the needle that has to be thread. When will people go out again? Well, they have to have somewhere to go, and they have to feel safe doing it. So here's a very scary graph. PricewaterhouseCoopers survey, 50 leaders from a cross-section of industries. I believe this was with CFOs. So they were asked, hey, if COVID ended today, how long is it going to take you to get back up and running? On March 15th, when people were asked, keep in mind, this was before even the California stay-at-home order came out, 66% of the businesses said less than 30 days, 34% in 1 to 3 months. They checked 2 weeks later, and there was a very large shift to the right, meaning more time. 66% now down to 36%. That's a 30% drop. 34% now up to 40%. That's good in terms of at least they didn't all go to 3 to 6 months. But a good portion, we're now at 24%. 2 weeks later, now it's gotten real bad. It's gotten worse. Let's not say real bad. That's not fair. 22% of the businesses in less than 30 days, 39% in 1 to 3 months. Okay. All right. Got it. 61%. Cool. 22% in 3 to 6 months. Okay. All right. 13% in 6 to 12 months. That's tough. 5% in more than a year. I would venture to say this 5% isn't coming back. That's, I think, going to be a contraction. That's where when we get to the projections with the unemployment rates, you're going to see that as we get, it's going to take into 2023. This number right here, 13% and 22% from April 14th, those are the two numbers to watch. The 39% is also obviously going to be important. We're looking to see, does that greater than 1 year number increase? If this keeps going well into May, this 13%, those very well might not be coming back either. There is a limit to what businesses can do and then be able to even be in existence when we hit the play button. So what about the unemployment projections? Goldman Sachs projecting 15% 2020. That's the most conservative. That's the scariest of the numbers. Let's use that. Worst case scenarios. Congressional Budget Office is predicting 12, Merrill Lynch at 10.6, JP Morgan at 8.5, Wells Fargo at 7.3. Let's stick with the 15. Let's not put rosy colored glasses on. They're predicting somewhere between 6 to 8% in 2021. 8% is kind of that borderline where if we're above 8%, we have a very, very deep problem. Predicting 5% in 2022, 4% in 2023. Gradual decline as the economy comes back online. The longer this takes to push the play button, the longer that will take. So what does the science say? In order to understand it, we have two questions we need to ask. What will be the depth of the unemployment and what will be the length? Depth meaning percentage, how many people? Length meaning how long, how many years? The Great Depression lasted 12 years and was very, very deep. You can see right there, 1933, 25%. 1/4 of the country couldn't find work. The Great Recession, 9 years, 3 of which were deep, 2009 to 11. So we had a little bit of depth, nowhere near the recession, or I'm sorry, the depression. But we were relatively short, 9 years. We had length, not a lot of depth. What about comparing the Corona recession predictions? 15% unemployment in 2020. That's deep. That's getting into the Great Depression range. 2021, we're back under 8%. 2022, 5%. 2023, 4%. So what does that look like graphically? Here's depth and length for you. Depth is up and down, the y-axis. Length is left and right, the x-axis. There's the Great Depression. 12 years, 25% down at the bottom. The Great Recession, 9 years, 9.9, call it 10%. Here's the predictions for the coronavirus recession. 15%, but we're done in 2 years. Very big difference. Very big difference. What about job losses in the Great Recession? How many jobs were created since the Great Recession trough from February 1st of 2010 to February 1st of 2020? 24.8 million. We've lost over 22 million jobs in the last 4 or 5 weeks. A lot of people would look at this and go, well, we just wiped out everything that we created. We've just lost every single gain since February 1st of 2010. Not every single. You see what I'm saying? True. Big difference, though. What created the need for 24.8 million jobs was a housing market and a financial system that were fundamentally weak. They were in bad positions. What's caused 22 million in the last 4 to 5 weeks is an event-based issue. If the coronavirus had not come to the United States, we would not be in a recession right now. We wouldn't even be talking about it. How quickly are those coming back? We've already discussed that. So there are some differences here between what's going on now and the Great Recession. All right? 8.7 million jobs, just some perspective for you. That's how many were lost in the Great Recession, the peak to the trough, 8.7 million. But what about San Diego? We got the Regional Economic Development Economic Development Corporation. Business survey analysis shows the impacts of the COVID-19 outbreak on San Diego's economy are severe, concentrated, and disproportionately affect small businesses and low-wage workers. These results are corroborated by skyrocketing initial claims for unemployment insurance both nationally and in California. While this is not fully reflected in the March employment data, it implies a dismal April jobs report should be expected along with downward revisions to the advanced March estimates. This is what we're seeing in San Diego. It's what we're seeing across the country. It is hitting small businesses, primarily low-wage workers. Small businesses, everybody, 50 people or less. 50 people or less. The low-wage workers, those are the servers. That's the office staff. Right? Those are the people that are getting hammered by this. We have another graph. This is also from the San Diego EDC. They partnered up with the Downtown San Diego Partnership, National City Chamber of Commerce, San Diego and Imperial Small Business Development Corporation, and San Diego Regional Chamber of Commerce. They asked small businesses, how many of you are anticipating employment reductions? You're going to see that there's a nice drop coming through here. But here's the question. Initially, 234 firms or businesses said yes. They obviously saw what was coming. The 19th was the stay-at-home order. So this could be, hey, make preparations, to which means, yeah, we're anticipating we're going to have to lay people off. A week later, it's only 87 firms. Does that mean that the difference between 234 and 87 laid people off? It very well could be. It also could be we've moved things around and we didn't have to. We will know more in the beginning of May when the new report is out. All right, so what about home values? Big take-home message. A recession does not equal a housing crisis. So what were some of the big contributing factors to the housing crash? Lenders making predatory loans, handing out money very, very easily to anybody. Buyers making ridiculous purchases, overbuilt markets, home equity positions. Those are the big four right there. There were others, obviously. But let's take a look and see, where are we today compared to where we were going into 2008, 2009. Housing is a foundational element of every person's well-being, and with nearly a fifth of the U.S. gross domestic product, GDP, rooted in housing-related expenditures, it is also critical to the well-being of our broader economy. Quote from Harvard. Many still bear scars from the Great Recession and may expect the housing market to follow a similar trajectory in response to the coronavirus outbreak. But there are distinct differences that indicate the housing market may follow a much different path. While housing led the recession in 2008-2009, this time it may be poised to bring us out of it. Right? Chief economist for First American Financial. With the exception of two recessions, the Great Recession from 07 to 09 and the Gulf War Recession from 90 to 91, no other recessions have impacted the U.S. housing market, according to Freddie Mac Home Price Index data collected from 1975 to 2018. It's National Association of Home Builders. So what about months of inventory? How many homes are for sale? All right, so let me orient you on this. Months worth of inventory, if we stop taking new listings, divide the amount of time it takes to sell them, that gives us how many months worth of inventory we have, how many months it would take us to sell everything we currently have if we took no new listings. 7 months or more, buyer's market. 6 months is neutral. Nationally, which is what the graph is, 6 months or less is a seller's market. In San Diego, we know that it's 4 months or less. So if we look and see 2006 to 2011, 2012, massive number of homes for sale. Overbuilt, too many homes. The supply was phenomenal. If we take a look where we are today, we're down in the 3% range. 3 months range. Very big difference. Simple supply and demand. In 2007, we had 8.2 months worth of inventory. Today, we have nationally 3.1 months. In San Diego, we're well under that. There are some zip codes in San Diego that are under 1 month worth of inventory. That is a sign of a very strong market, or what could be a very strong market. What about home appreciation rates? If you look at the graph in red, 6 years leading into the housing crash, those are absurd appreciation rates. 12.5% a year. And, it was overbuilt. There was not a lack of supply. If we look at the last 6 years, 2014 through 2019, we see far more reasonable numbers. The best year from the last 2017 at 6.4% appreciation, doesn't even break. It wouldn't replace any of those as being worse. It's under the best year, it's under the worst year of 2001. It's a big difference in appreciation rates. Home equity is another big deal. From 2005 to 7, the Americans cashed out $824 billion of their home equity to finance lifestyle. 2017 to 19, we apparently learned our lesson. $232 billion. There's a big difference in equity position. Right? The chief economist at CoreLogic, our home equity report found that at the start of 2020, homeowners with a mortgage had an average equity of $177,000. $177,000. That's a big difference. The last slide, remember the billions of dollars of equity that were removed there? That's not the case anymore. It's not the case. So if we end up in a far bigger recession, are people going to walk away from their homes for $177,000? Are they going to walk away from that? No. What if the housing market took a 25% hit, 5% more than 2008, 2009? That 177 goes down to about 132,000, 133,000. People aren't walking away from that. Short sales, not coming. Not like we've seen them before. 53.8% of homes in the United States have at least 50% equity. That means the owner owns outright more than half the property. 37% of them, they're owned outright, free and clear, no mortgage. 26.7% of the mortgaged homes have at least 50% equity. That's a big deal. Big difference. What about the lender side? 2006 on the left side, right? We're looking at the mortgage credit availability index. How easy is it to get money? The higher the number, the easier it is. 2006, it was 868.7. This was buyers making bad decisions and lenders making even worse decisions, and some of them being predatory. When a kindergarten teacher can walk into a bank and tell a lender, I make $150,000 a year and I would like to buy a $5 million house, and they say, no problem, sign here. That's what we had in 2006. Today, the number is at 181. It's a lot more difficult to get a loan, especially over the last couple of weeks. Percentage of median income needed to purchase a median priced home. In 2006, it required 25% of your income to buy a home, the median priced home. Today, it's at 14.8. It's a big difference there. So what about home values in recessions? During the last 5 recessions, here's what we saw. 6.1% appreciation in 1980. 3.5% appreciation in 1981. 91, we had a 2% drop. 2001, we appreciated 6.6%, and we took a bath in 2008. Quote from Ivy Zellman, supported by our analysis of home price dynamics through cycles and other periods of economic and housing disruption, we expect the home price appreciation to decelerate from current levels in 2020, though easily remain in the positive territory year over year, given the beneficial factors of record low inventories and a historically low interest rate environment. It's good news. So what are the projections? Here we go. Pre-COVID, post-COVID. So in 2020, the pre-COVID projections, 4.7% appreciation. Now that the COVID virus is here, it's been downgraded to 3%. Okay. Not ideal, not bad, not ideal. 2021 was originally projected at 3.8%. That's been upgraded now, 4.2%. There were no pre-COVID predictions for 2022, but now we do have them post-COVID. There you go. That's the effect, projected effect, of the coronavirus pandemic on housing. So based on what we see, know, and what the science says about the housing market, we know that there are far fewer homes for sale. We know that the appreciation rates are far more under control. We know that homeowners have a far better home equity position. And we know that the mortgage credit availability index is a lot more reasonable. Home value predictions was on the last slide. That's good news. So based on what we see, know, and what the science says, the housing market largely led the way in 2008, 2009. In 2020, the housing market is positioned to lead the way out of the coronavirus recession in Q3 and Q4 into 2021. That's good news. So the executive summary, all right, if you were skipped right here, good for you, created on Monday, April 20th. All right, so methodology, very simple, looking for long-term and reliable resources for market information analysis, as well as the science behind their analysis. Those are the primary sources we're looking at. There are definitely more than that. So the disclaimer as we get going: 1, no one can give you perfect advice. 2, this is what we're seeing take place. 3, this is what the science has to say. So based on all of this above, this is the best advice we can give you today. We know that 96% of the country has to stay at home right now. It means new listings and sales are going to be lower. We know sales are going to be down. It just hasn't hit the news yet because it hasn't passed. We know that unemployment has skyrocketed in the last 4+ weeks. But we know also real estate is continuing to happen every day. So based on what we see, know, and what the science says, we expect to see a very sharp drop to the bottom in Q2 with the economy skyrocketing back in Q3, Q4, and into 2021. That's the best advice I can give you right now. 2020 GDP predictions. Morgan Stanley, Goldman Sachs, JP Morgan, Wells Fargo, they all agree. V-shaped recovery. That's good news. And the analysis of the U.S. Bureau of Labor Statistics. So this is the unemployment report from April 3rd. Here's your here's what we've looked at with unemployment claims. 3.34 million, 6.9, 6.5 million, 5.25. We don't have the data yet from the 18th. Should be out later this week. So the question that we need to ask about this: who's lost their job? What industries are making up these numbers? Now, I need you to understand something before I start with these coming through. This only accounts for the first 700,000 of 22+ million. This is not indicative of what we're going to see on May 8th when the next report comes out, but this is the best that we have right now. Food and drink services, they're coming back. Child daycare workers, parents, you tell me, are they coming back? Healthcare offices, dentist's office, hospitals, elective procedures, non-life-threatening procedures. Those are all coming back. Construction workers coming back. Social distancing will determine how well that works or doesn't. The accommodation industry, retail, and temporary services, they're going to come back, just not as quickly. The government threading the needle or failing to will determine this. There's also the 10% of industries that have been going away for a while, and they're going to continue to, things like the coal industry. So 3 key questions. When is the pandemic going to be over? When will the economy come back? And when will people go out again? The interplay between 1 and 2, that's threading the needle. The federal, state, and local governments have to balance public health and safety in one hand and the economy in the other. If either of those two outweigh the other by too much, we have ourselves a big problem. Here's a graph from PricewaterhouseCoopers. A bunch of CFOs were asked, how quickly can you come back online? We can see that it's continually shifted from left to right. The less than 30 days has gone from 66% to 36% to 22%. The good news is 39% think they can get back online and moving within 1 to 3 months. 22% in 3 to 6 months, 13% in 6 to 12 months. That's concerning. That 5% in more than 12 months, I would guess that those businesses aren't coming back. If this extends into the middle of May, especially into late May, that 13% will more than likely continue to migrate to the right into the greater than 12 months, which very well might mean that those jobs aren't coming back either. So what about the projections for unemployment? Goldman Sachs is predicting 15%, Congressional Budget Office at 12, JP Morgan at 8.5. Let's go with the scary situation, 15%. They're also projecting 6 to 8%, which is under that 8% guideline for we have ourselves a lot of people. 5% in 2022, 4% in 2023. So here's the depth and the length, right? Depth up and down, length left and right. So the Great Depression, 25% unemployment. That's deep. That's a lot of people. It took 12 years to recover from it. The Great Recession, 10%. There's some good depth there. It's not anywhere close to the Great Recession, but it took 9 years. Less depth, more length. Here's the coronavirus, 15%. That's deep, but the length is very, very short, 2 years. That's good news. So looking at the housing market, month's worth of inventory, 7 months or more is a buyer's market. 6 is a healthy neutral market. 6 months or less nationally is a seller's market. 4 months is where we're at in San Diego for a seller's market. Currently, we're well under that. All right, so looking nationally between 2006 and 12, we can see we were overbuilt. We had more homes than we knew what to do with. If we look at where we are today, we can see we're well under that. In San Diego County, we're well under 3 months of inventory. I think we're well under 2 months at this point. And there are some zip codes we're definitely under a month worth of inventory. 2007, we had 8.2 months. Today, we have 3.1 nationally. Completely different position than where we were leading into the Great Recession. Home equity and appreciation. 53.8% of the homes in the United States have at least 50% equity. 37% of all the homes in the country are owned outright. 26.7% of the homes that have a mortgage own at least 50% of the home. Annual home price appreciation. You can see the 6 years leading into the housing crash, insane appreciation. And oh yeah, we were overbuilt too. Last 6 years, a lot more reasonable. 2017, 6.4%. That's lower than the worst year from 2000 to 2005. Different position. Here's the home prices in the last 5 recessions. 6.1% appreciation, 3.5% appreciation, 2% depreciation in 1991, 6.6% appreciation in 2001, and 2008 we lost 20%. Housing led the way. So what are the projections? Originally, 2020 was projected to be 4.7%. That's been downgraded post-COVID to 3%. 2021 was originally projected at 3.8% appreciation. That's now been upgraded to 4.2%. And in 2022, there were no projections prior to the COVID virus. Now the new one's 4.6%. We are not expecting to see a major housing issue at all. So break it down. The recession, We know 96% of the country's at home. That means that new listings and sales are going to be down. We already know that. So based on what we see, know, and what the science says, we expect to see a very sharp drop to the bottom in Q2, with the economy skyrocketing back in Q3, 4, and into 2021. With unemployment, we know that unemployment has skyrocketed in the last 4+ weeks. We also know that 60 to 70% of those jobs are going to return somewhat quickly upon reopening the economy. We know that about 22% of the businesses are going to be able to open within 30 days and another 39% within 1 to 3 months. We'll see if those numbers remain the same. The longer this takes, the smaller those numbers are going to be. What about home values? We know that a recession does not always equal a housing crisis. We know there are striking differences between today and 2008. Fewer homes for sale versus 2008. Homeowners have an average of $177,000 of equity in their homes. Loans are much tougher to get than they were in the early 2000s, and the rate of appreciation since 2014 is far more reasonable. So based on what we see, know, and what the science says, the housing market largely led the way in 2008, 2009. In 2020, the housing market is positioned to lead the way out of the coronavirus recession in Q3, 4, and into 2021. That's good news. All right, well, there you go. Those are long-term, trusted, reliable sources of information for the recession, for unemployment, and for the housing market as we go through this. If you guys have any questions, all my contact info is right there. Please call, text, or email. Would love to dig further into this based off of your specific circumstances. Hope you guys have a great day. Take care.